Chuck Carvel. I'm the Chuck in the Markets Up Chuck. And today's post was titled Recessions Are Rare. And the whole point of the post was to remember that most of the time the stock market's really been a good place to invest. Most of the time the economy is pretty strong. And every now and then we get these bear markets and we get these recessions. So I'm going to show you two charts today to kind of make my point. The first one is a chart offered by Haver Analytics, and the moral of this chart is that earnings determine the market's price over the long run. And if you look at this chart, I want you to notice, the red line here shows the operating earnings on a quarterly basis of the S&P 500, and you can see there were periods here where earnings dropped, and following each of those periods, were followed by long periods of rising earnings. Even after our last recession back in 2001, which you can see right here, you can see that was followed by, several years of rising earnings and rising stock prices. Now, this chart starts in 1965 and ends in 2004, and that's courtesy of EDMP Inc. and Haver Analytics. But the reality of it is I wanted to show you this to show you that over a long history, it's a 40-year-plus history here, you can see that, the stock market has generally risen. This was the irrational exuberant period that we saw, back in 2000, 2001. And, of course, things got kind of wacky for a while there, but then we ended a long, extended bull market after that. So I'm going to update this now and look at a more current chart. Now, the last chart I showed ended in 2004, which was approximately in here. This goes back to 1991 and just shows the last 20-year history. What I have here is the normal price-earnings ratio of the S&P 500 of 15, and then the black line, of course, are monthly closing stock prices. I want you to see we had kind of some weakness back in the early 90s, if you recall, where earnings were dropping in the S&P and was kind of a quasi-recession. That was followed by many, many years of, good solid earnings growth. Then we hit the recession in 2001, and that was followed by, 4 or 5 or 6 years, I guess 5 years of real strong earnings. Now we've hit this recession, and I guess the logic would be, based on history, that once we, we're already starting to see a rising forecast of earnings. I want to point out that this is all forecast here. So, we are probably in line for a real good long recovery once things get, better. They are going to get better. Obviously, there's still problems. There's still economic issues. There's, worries about inflation, et cetera, et cetera. But as the old saying goes, Wall Street climbs the wall of worry. The bottom line is the best time to be buying stocks is when they were cheap. I did some blogs in, earlier in this year in March showing that the S&P had gotten ridiculously cheap at that point in time, and of course that was before earnings had even fallen further, but the reality of it is we've seen a nice rally since then. I would argue the market is maybe slightly overpriced today on a general basis, but as I showed in previous blogs, there's an awful lot of really good companies out there that can be bought, but all in all, depending on how much earnings do recover, buying low is what it's supposed to be all about and selling high, and the best time to buy low is when things are bad, and things have been bad, stock prices have gotten low, and I think, the future is, going to look good. Don't extrapolate the current problems far out into the future because, as I point out in the blog, things will change. It's Chuck Carvel saying thanks for listening. I'll talk to you again tomorrow.